Look, I know what you're feeling right now. You turn on the news and it's just noise. Inflation is still sticky, global debt is exploding, and everyone is predicting a recession in 2026. You're scared, and honestly, you should be. But here's the problem. Most of the advice you see on YouTube is absolute garbage. They're telling you to buy risky individual stocks, gamble on crypto, or start some complicated side hustle. That is the fastest way to lose everything when the market turns ugly.
Today, we're cutting through the noise. I am not going to teach you how to get rich quick. I am going to teach you how not to get poor. We are building a defensive fortress around your money using the only proven strategy that works long-term, low-cost index funds. By the end of this video, you will have a list of the 5 exact funds you need to survive and thrive in 2026, no matter what the economy throws at us. Let's get to work.
Welcome back to the channel. If you're new here, we don't do hype. We do financial security. Our strategy for 2026 is simple: defense first. The goal isn't to beat the market by 50%. It's to make sure your portfolio can handle a punch. We are looking for broad diversification, low fees, and proven track records. We want to own the entire haystack, not search for the needle. I've handpicked 5 index funds that form the perfect defensive team.
You can buy all 5 or just pick 1 or 2 to anchor your portfolio. Let's start with the foundation. Fund number 1 is the Fidelity 500 Index Fund, ticker symbol FXAIX. This is your cornerstone. It tracks the S&P 500, which means you are buying a slice of the 500 largest, most profitable companies in America. These are the giants that drive our economy, companies with huge cash piles that can weather any storm. Why this fund specifically? 2 reasons. 0.15%. That's basically free. Over decades, those low fees add up to thousands of dollars more in your pocket. Companies has historically been a terrible idea. Even if we hit a recession, these are the companies that will survive and lead the recovery. You own technology, healthcare, financials, everything. It is the ultimate bet on American resilience. If you only buy 1 fund on this list, make it this one. But America isn't the only game in town, and in 2026, you cannot afford to have all your eggs in one basket. And number 2 is the Vanguard Total International Stock ETF, ticker symbol VXUS. This fund gives you exposure to thousands of companies outside the United States. We're talking about massive, stable corporations in Europe, Japan, Canada, and emerging markets. Why is this crucial for defense? A US market zigs while the rest of the world sags.
Dollar weakens or our economy stalls. Having international exposure acts as a shock absorber for your portfolio. It's about spreading your risk across the entire globe, so a crisis in one country doesn't wipe you out.
Now, let's talk about getting paid while you wait. In turbulent times, cold hard cash is king. SCH Dividend Equity ETF, ticker symbol SCHD. This is my favorite pick for a defensive income stream in 2026. This fund doesn't just buy any company that pays a dividend. It focuses on high-quality companies with strong financials and a history of consistently increasing their dividend payouts over time. Think about it. If a company can afford to pay you more and more cash every single year through good times and bad, that is a sign of incredible financial strength. These are value stocks that often perform better than flashy tech stocks when the economy slows down. This fund gives you a steady paycheck from your investments, which you can reinvest or use to pay bills. All right, we've got stocks covered, but a truly defensive portfolio needs ballast, something that goes up when stocks crash. Fund number 4 is the Vanguard Total Bond Market ETF, ticker symbol BND. I know, bonds are boring. That is exactly the point. It tracks the U.S. investment-grade bond market, government treasuries, and high-quality corporate bonds. When the stock market panics, investors flood into the safety of bonds, driving their price up. The fund is your portfolio's airbag. It won't make you rich overnight, but it will keep you from panic selling when you see your stock funds drop 20%. In a volatile year like 2026 is shaping up to be, you need this stability. For our final fund, we're going to add a little bit of offense, but we're doing it smartly. Fund number 5 is the Invesco QQQ Trust,
ticker symbol QQQ. This fund tracks the NASDAQ 100, which is heavily focused on top-tier technology and growth companies. Now, this is more volatile than the S&P 500, so why is it on a defensive list? Because the companies in this fund, the Apples, Microsofts, and Nvidias, are arguably the most powerful cash-generating machines on the planet.
They have fortress balance sheets and are leading the AI revolution. In a world where technology is everything, owning the best of the best is a form of long-term defense. I wouldn't put 100% of my money here, but as a part of a balanced portfolio, it ensures you don't miss out on the future growth drives. S-Dividend Equity ETF, the Vanguard Total Bond Market ETF, the Invesco QQQ. You don't need to guess, you don't need to stress. Just buy the market, protect your downside, and let time do the work. You don't need to complicate this. A simple portfolio built with these powerful, low-cost tools is all you need to build real, lasting financial security in 2026 and beyond. Stop trying to outsmart the market and start building a fortress that can withstand it.
If you found this helpful, hit that like button and subscribe. I'm dropping a video next week on exactly how to allocate your money between these funds based on your age. You don't want to miss that. Thanks for watching and stay safe out there.